Hi, this is Michael Joyce from Agili, your personal CFO, and I'm pleased to share with you our thoughts and viewpoints for the fall of 2019. I think by all measures, the investment performance for 2019 has been great. But we are looking forward into the future, and there are some storm clouds out there that we're keeping our eye on and how they might impact our clients' investment portfolios. Now, the one thing that we don't think is going to be a big storm cloud, at least not for the long term, is the impeachment hearings and everything that's going on in Washington. Maybe a little bit of a short-term impact, but what the historical record shows is that the political aspect of it is inconclusive, and what's happening in the economy is a lot more important to the financial markets. And right now, the economy is showing some signs of slowing in the business sector. And this has been mainly caused by some things we've talked about before, trade and the trade wars and tariffs. It's causing some uncertainty, and business investment is slowing. But that's really been counteracted, at least so far, by very strong consumer spending. You know, consumers are out there keeping the economy afloat, and really with good reason. I mean, the unemployment rate is still around 50-year lows, and there are real wage increases that are going on, and that's definitely a good thing. But we are keeping our eye on whether it might be a slowing in corporate earnings, which could then seep into slowing of consumer sentiment, which could negatively impact the financial markets. Another thing that's happened over the past quarter is that interest rates have fallen a lot. So I promised Amber Ott, my co-producer, that I wouldn't talk much about the inverted yield curve because this video is only going to be about an hour long. But there are a couple things that I should mention. So an inverted yield curve is where the shorter term interest rates are actually higher than longer term interest rates, which is not how things normally work. And as I've said in the past, inverted yield curve is an excellent predictor of a future recession, just not right away. I mean, typically it happens 18 months or 2 years after an inverted yield curve. And this inverted yield curve is a little bit different, you know, because past inverted yield curves have been caused by the Fed fighting inflation. But so far, inflation, at least consumer inflation, is pretty much under control. But what has caused the drop in interest rates more than anything else has been demand from foreign investors. So if you think about it, in some countries like Germany and Switzerland and Japan, interest rates are negative. In other countries, they're very close to zero. So if you're a German institutional investor, you're going to look at maybe buying 10-year US Treasury notes, and even after you have some costs for hedging your currency, you're still in a lot better shape than you are by investing domestically. So that foreign demand has increased prices of US bonds, and as the prices increase, bond yields have come down. So lower interest rates are really pretty good actually for US stocks and real estate, asset classes like that, but not so good for the yields on bonds. And that has been a little bit of a struggle for us we're committed to getting inflation-adjusted returns on bonds, and we will keep working on that. So this is a good time of year also to talk about taxes. And I know I've talked about taxes before, but what you really should be looking at is where you stand with your taxes for the year. I mean, as I said before, this has been a pretty good year for the stock market, and there have been capital gains that have been incurred, and a lot of mutual funds will be paying out pretty hefty capital gains distributions more towards the end of the year. So now is a really good time to get together with your financial strategist at Agili and do a tax projection. Make sure that you have enough withheld from your paycheck or paid in through quarterly estimated payments so that you're not going to be in a penalty situation when the time to pay your taxes and file your taxes comes around next year. This is also a good time of year to take care of a lot of year-end stuff and not to wait until right at the end of the year. For those that have to do required minimum distributions on IRAs, now's a good time to start that process in motion. If you're making charitable contributions, whether you're making it with cash, whether you're doing it with appreciated stock, or whether you're doing a qualified charitable distribution from an IRA, now's a good time to look at what's the best way to do that. Talk to your financial strategist at Agili on best ways to optimize that situation and do that. Because if you're going to be waiting until December 24th, a lot of the custodians are really going to be backed up at that time, and it may not get done by the end of the year. So I've been very pleased to share with you our thoughts and viewpoints for the fall of 2019. If you do have any questions, feel free to contact me or contact your financial strategist at Agili. Also, check in with our website, agilipersonalcfo.com, or on our Twitter handle and see what our current thinking is. Thanks and have a great day.